Well, it looks like it's going to be another one of those Fridays, another big red day to close out the week where the NASDAQ is down 3%, the S&P 500 down 2%, and the Dow Jones down 1.5%. Why are all these indices trading down today? What is the big catalyst causing stocks to go down across the board? It's good news. I kid you not. This is the headline news. This is the big catalyst for today's sell-off. Unemployment rate falls to 3.5%. People are leaving their homes and finding work. And that's what's causing the stock market to sell off. So if you think that the stock market makes sense and that it trades based off of the economics, based off of what the economy is doing, you'd be wrong. The economy is doing good right now. The stock market's doing bad because, of course, there's other factors at play. The strong job market means that Jerome Powell has more work to do. He's made it his goal to take down inflation, and part of that is slowing down this booming economy. So that's what's causing the sell-off today, but that's not what I want to focus on. In this video, we're going to be talking about a specific opportunity, potentially a big opportunity in the market called Ulta Beauty. Now, Ulta Beauty is a store and a company I'm sure most of you have heard of, especially if you have a girlfriend or a wife. It's very popular amongst girls and women because they sell a lot of beauty products, a lot of makeup. And on the outside, it looks like a very plain store, nothing too special about it. But when you're looking at the stock and the performance of it, at least over the past decade, the past 20 years, the stock's performance has been incredible. It's been growing at a rate of around 24% per year, which if we put that against the S&P 500 looks something like this. They're not even close. It's absolutely crushed the general market. Even if we throw in the QQQ, which has had exceptional performance over this time, compounding at 12%, that top line there, that performance is from Ulta Beauty. It's crushed every major index you could possibly bring up. This company so far has compounded incredibly well. It's grown to pretty big size, and it seems to be well managed. So it's caught my attention. And contrary to the common phrase, in terms of companies and management teams, oftentimes the past performance is an indicator of future performance. If a company's compounded this well for that long, there's some characteristic in it that's making this thing work. So in this video, we're gonna figure out Ulta Beauty. We're gonna go through the entire research analysis on this company, and you'll be able to see how I look at companies, how I evaluate them both in terms of their qualities, their characteristics, and in terms of valuation. I have two different frameworks per se that I use for these type of things. One of them is called the compounder checklist. This is a qualitative framework to try to figure out if a company has the qualities of a compounder. So we're going to use this checklist and run it across Ulta Beauty and see how it fits together. Then I also came up with a valuation framework, which has two different methods of valuation to try to determine if this compounding company is at a good valuation, if it's now worth it to buy. So we're going to run it across those two different things. We're going to look at the fundamentals of the company. We're going to try to figure out its future outlook and then see if it's a company that could end up in my portfolio. Before we jump into Ulta Beauty specifically, we have to do an update on the Story Fund. And I know we're getting crushed today. This has been a very tough year. The Story Fund is down $40,000. We've put in a total of $137,000. That's what I've contributed to this, and we're down 40,000, which if we compare this against the S&P 500, this is what it looks like. SPY is in red. The Story Fund, this tech portfolio, is in blue. So we're below the S&P 500, but we've actually been closing the gap a little bit. We have the S&P 500 down 7%, so it's taken a dip recently. The Story Fund down 23%, and you can see how they separated at the beginning of the year. I'm going to be tracking this for multiple years. We'll see how this does over time, but right now it looks pretty ugly. And the common theme is basically everything that I've invested in this portfolio since 2021 has gone down. Almost every single thing. Apple is a holdout. This is one of the few that's in the green. And then Crocs, only because it's a new position, is in the green. But everything else that I've invested in outside of Apple is firmly in the red. In my opinion, this tells me that these companies really haven't had time to trade on their fundamentals. Right now, they're trading on macroeconomics. There's nothing I can do about it unless I want to become a macro investor, which I'm not. So that's the update on the Story Fund. So let's go ahead and jump into Ulta Beauty. And the first thing that I want to do before actually getting into the numbers, and I think an important step that many investors actually skip, is actually learning at least a base level of what the company is, what they do, what their product are, and what their customers are, right? We have a video here, and I think this goes through it. This girl, she has a YouTube channel, and I'll give you the channel here. It's Juicy JAS. I don't know how you say that, but Juicy JAS, that's her channel. And she has a couple of videos where she goes through and does a shop with me on Ulta Beauty. So this is one of those videos where they like, you know, they'll walk through Costco or they'll walk through whatever store. And she doesn't show a lot of like the bigger shots with the layouts, but basically what I get watching this, because I really haven't been into many Ulta Beauties. I don't remember going through them. My wife goes to Ulta Beauty all the time. It's where she prefers to get her makeup. And basically what Ulta Beauty is what you're seeing here. They just have everything for girls. Everything that has to do with beauty. You have e.l.f. there, right? e.l.f. on a shelf, isn't that one of Jeremy's stocks? You have all these different brands that are aggregated into one store, which is Ulta Beauty. And then the store has different memberships and different apps to give you points to earn rewards. So it kind of has some customer lock-in there, similar to how Starbucks has their rewards, right, that keep you shopping at Starbucks instead of other coffee companies. Ulta has the same thing, but it's just aisles and aisles of makeups and things for eyelashes. Now, I'm no pro on this stuff. I don't have a strong opinion on where to shop for makeup, but most girls, most women I talk to, they like Ulta Beauty, both young and old. Both high schoolers, people in their 20s, people in their 50s. They shop at Ulta Beauty. In fact, when I look at this, a way that I think of this, something I thought of when I was watching this, is it almost reminds me, like Ulta Beauty reminds me of almost like Home Depot for guys. It's just walls of things that most girls, not all of them, I don't want to generalize too much here, but most girls are interested in makeup. That's just the case. Most guys love the company Home Depot. That's why I see so many investors that's mostly male-dominated investing in companies like Home Depot. But we have a company that I think is somewhat similar here. We have Ulta Beauty, which sells all these products that girls love. The company is doing fantastic, but I think in many cases it gets ignored in the investment industry because, again, most investors are guys. That's by far the majority of my channel. It's about 92% male, 8% female. So with that, there's a couple observations right at the beginning when looking at this company. My first observation right off the bat is it's probably more defensive. My natural assumption is it's a more defensive, less cyclical industry than most industries because it's having to do with beauty. And beauty is something that's going to be popular all the time. People want to look good all the time. Girls want to look good all the time. They want to look good tomorrow. They're going to want to look good next week, even if there's a recession or even if the economy's booming. In either case, girls are going to want to have their makeup and look good. So I think it's naturally a very defensive industry, one that will be around for a long time. It's never going to go out of style. And I don't see any type of major disruption to at least the fundamentals of the industry. Having said that, we're going to refer to the compounder checklist. If you're not aware, this is something I put together that takes a lot of inspiration from Terry Smith, who focuses on high quality companies. There's specific metrics he outlines. It also focuses on things that I've learned from different studies from Morgan Stanley on things that compounders have. Common characteristics in companies that are compounders, meaning they earn money for long periods of time. They're highly resilient companies, highly durable. This is my list, and it goes into 6 different points. So let's go through it one by one and see how Ulta Beauty plugs into this list. Number 1, we have strong franchise durability. Does Ulta Beauty have strong brand recognition and pricing power? Brand recognition usually leads to some form of pricing power. In my opinion, I do think that Ulta Beauty has brand recognition. If you want evidence of this, just go up to any girl and ask her, do you know what Ulta Beauty is? And what do you think of that store? They'll A, most likely have heard of what it is, they've been there before, and B, they most likely will view it favorably. That means that they know about the brand and they like the brand. And in my opinion, it's one of those companies where you can go to any state, you can travel or be on vacation. If you find an Ulta Beauty, you know what you're going to get. You're going to get that consistent experience across the board. All the locations look the same, the pricing's the same, the employees are treated the same. So it's kind of like going to a Walmart across different states or a McDonald's or a Costco. They have that brand recognition, which I think is a very important thing in a compounder. Most of them have this. Number 2 is a financial metric, not a qualitative one. High returns on capital employed. This is a must. A company that's a true compounder must have this attribute. Terry Smith highlights it as the biggest distinguishing feature of a high quality company. Same with Warren Buffett in his 1979 shareholder letter. Returns on capital employed are the most important identifier of the quality of a company. Now, This sounds like some financial shenanigans. What is return on capital employed, or ROCE? What does it actually mean? Here's a very simple example of it. I run a household. If I went out to the bank and I borrowed money from the bank at an 8% interest rate, that is my cost of capital. That's the price of getting money. Then if I got that money at 8% and I invested it and got a 4% return, I destroyed wealth because I took money at 8% and I invested it with a return of 4%. That means that I earn a low return on capital employed. Now, you might think that no company does that because that's obviously losing money. Many companies do that. In the market, there's hundreds of them. These are many of the value companies, the low PE companies. Airlines do this. Auto manufacturers do this. Lots of industrial companies and oil companies do this for long periods of time. Lots of companies borrow money, or their cost of capital is higher than the amount that they can reinvest that money. And in the process, they destroy shareholder wealth. Companies that have high returns on capital are companies that can borrow money at that 8% cost of capital, and they can reinvest it and earn 20% or 30%. Those are very high quality companies because they generate wealth for the shareholder. Now, to figure out number 2 and whether Ulta actually meets this requirement, we can bring it up on Qualtrim here. If you're not aware, Qualtrim is a website that I developed with a previous coworker it's a stock information tool. If you haven't tried it out, there's a link in the description. It's part of the Patreon membership. Go ahead and try it out. You get a free trial for 3 weeks now. So you can really test this tool out and see if it's worth the $10 a month. In my opinion, it's very well worth it. But let's go ahead and bring up Ulta Beauty here. We just type in the ticker symbol. It brings up all the financial metrics. One of them is called ratios, which shows us the return on capital employed. This nice little chart. What I see is a company, and I don't want to focus on the recent years because it had 2020 and COVID there. We can kind of cross that out. But what I see overall is a company that at the bare minimum has over 10% since 2009. Since 2010, it's gone up to 15% or above. Now, we can assume the cost of capital right now is around 8 to 10%. That's the cost of capital. So every time a company earns above an 8 to 10% return on capital employed, that means that they're generating wealth for the shareholder. And Ulta Beauty has been doing this, earning high ROCE, 20% or above, for literally over a decade now. The average of the market, the S&P 500, is 16%. So to look at this and outline that, this is the average of the S&P 500, the average ROCE. Ulta Beauty generates routinely, year after year, far more wealth for the shareholder than the average of the S&P 500. And these are precisely the companies that are the highest quality in the market. The companies that Terry Smith highlights as the one generating the most wealth. And as you can see, the returns on the company show the generation of that wealth. Now, does it meet number 2? Yes, Ulta Beauty more than meets number 2. These 30% plus returns on capital employed are very high, much higher than the cost of capital. It leaves them a lot of room between the cost of capital and their returns. Number 3, recurring revenue. When people hear about recurring revenue, they think of subscriptions, software companies. But recurring revenue, the definition of that can be expanded to far more than just software companies. It's any company that makes revenues from a large number of repeat and predictable transactions. So you think about a company that sells toilet paper. They're not really a subscription, but they may as well be. Everybody needs toilet paper. 2020 proved that. It's a recurring purchase that you have to buy on an incremental basis. It's not going away anytime soon. That's a small, incremental, predictable purchase from these companies. They know exactly what demand's going to be all the time. So that is a recurring purchase. The type of companies that are not recurring revenue are companies that have big contracts. So one-time big contracts. You have companies that are, defense contractors. You can throw in Lockheed Martin that gets these big contracts from the government. You have Palantir that has to have these big government contracts. Those aren't really recurring revenues because you don't know if the deal is going to go through. Their revenue is very lumpy. They might get the contract, they might not. It's a little bit less predictable. Other examples are in the movie industry. If you make a big blockbuster movie, you don't really know how it's going to do until it's released. The company doesn't even know how it's going to do, right? Some of them are huge flops. Some of them do really well. That's not predictable. And then another example is auto sales. You have car manufacturers, which are lumpy one-time sales where somebody buys a car and they keep it for the next 10 years and they can extend the life of it during a recession. So we're focusing on companies that have a recurring revenue. And I think that makeup, beauty products, skincare products are firmly in that recurring revenue category. The products expire. The products are consumable. You can't extend the life of them forever. They're not lumpy in purchase. You have to get them frequently, on a frequent basis, because you run out of it. And they're products that I think will also do well during recessions. They're not one that you only buy part of the year. Now, moving on to number 4, we have minimal financial leverage. This is another financial metric, but it's one that I put a lot of emphasis on. It's all right if a company has some debt. Some companies use it very strategically, but I think the thing to avoid here is a company that relies on debt to grow. It can't grow without debt. That's the type of companies we're wanting to avoid in terms of compounders. So a way that I look at this and try to determine whether or not the company is actually relying on the debt or whether they're just using it strategically, you take the total long-term debt and you see if it's less than 3 times last year's EBITDA. Let's go ahead and look at this with Ulta Beauty here. We have the debt here. We can switch this to quarterly. And right off the bat, I want to bring up and look at the debt, but they don't have any debt. The debt right here is this pink line. They had some back in 2020. They took on $500 million. I'm guessing they didn't know what was going to happen. So they said, look, let's take out some money before the banks say no, just in case, right? Just in case. And then once they realized things weren't going to go on forever like that, they quickly repaid it. Now, they do have capital leases. These are basically rental contracts for their locations. That's not long-term debt. Not the same thing, but it's worth noting. But what we have is a company that has $400 million in cash, 0 long-term debt, and then they have some rental contract agreements, $1.8 billion. If we look at their actual EBITDA, and we look at this annually, compare it to their last year's EBITDA, we have 2022 at $1.5 billion. This is more than their total, obviously their long-term debt, which they have 0, but this is also more than their rental agreements. So in terms of leverage, this company has really none. They're not growing with leverage, which is something I love to see. I very much prefer companies that are not indebted. That's a huge one for me. Because you know you're not going to run into trouble with these companies. When things go bad, it's always the companies that have a lot of leverage that are the ones that tend to blow up. Now, number 5, we prefer companies that are low cyclicality. So every company and the whole economy has a market cycle that we go through. Times of booms and busts, times where the economy is doing really well, times where we go through recessions, inflation, and all different things. And with the companies that we invest in, we want to minimize that cyclicality. We can't get rid of it completely, so I put low cyclicality, but I look for companies that can remain highly profitable during all parts of the economic cycle. Even if their profits go down a bit, I want them to remain profitable. We look at Ulta Beauty here. We can take a look, and I think an easy way to gauge this is just check out their profitability metrics during recessions. We can look at Ulta Beauty back in 2009. This is what it looks like. In 2008, they made 48 cents of earnings. 2009, it went down to 43. Is that terrible? That's not terrible. And it recovered right away in 2010. So they're still growing during this time period very quickly, opening up stores, and they're still making profits, still positive EPS. The net income, again, 2008, it was 25 million. 2009, it was 25.2 million. Low cyclicality so far. And then even looking at the charts here, I see a company that is incredibly predictable with their earnings. Go ahead, open up your Qualtrim account, type in some ticker symbols and see different companies. Most of them are not this resilient. And I give them an exemption for 2020. I think that is a very unique circumstance that we should not factor into the situation here. Overall, this is one of the most low cyclicality businesses we could possibly find. And that's by virtue of them being in this amazing industry, which is the beauty industry. Very defensive and reliable. Again, people, especially girls, they want to look good all the time. They don't only want to look good during certain parts of the market cycle. Now, number 6, we have returns capital. This is something that I typically prefer, which is a company pays a growing dividend or they do buybacks. And we can, again, take a look at Qualtrim here and see if this company is doing that. We have 2 different things we can look at. It seems like they've paid 1 dividend in their history, so they're not a dividend payer. They have no dividend yield right now. That's fine, but we want to see if they're doing buybacks. If we look at these shares outstanding, this shows you if the company is doing buybacks because you can just see if the shares are going up or down. the shares are generally speaking going down, they're doing buybacks. If the shares are going up, they're doing dilution. And as the shares go down, you as the owner own more of the company. It's a way the company quite literally returns capital to you. My preference is dividends, but buybacks are another good way to do that. Now, if we look at this, Ulta Beauty does a lot of buybacks. Over the past 10 years, the amount of shares outstanding has gone down on a compound annual growth rate of minus 1.68%. So that's similar to them doing a 1.68% dividend that whole time. They're reducing that amount of shares outstanding. Over the past 5 years, they've actually increased this by almost double, 3.75%. So you can see the amount of shares outstanding going down, maybe 3 to 4% per year. And you can expect that in the future. That's a really positive thing. As they're buying back shares, it bumps up their EPS and it gives you more ownership of the earnings of the company. So if we review the compounder checklist as a quick screener for the qualities of the company, we have number 1, which is a pass. They have brand recognition, and I think they have some pricing power. Number 2, they have high returns on capital. Number 3, they definitely have recurring revenue. Number 4, they have no financial leverage. They're a very conservatively managed company. Number 5, they have very low cyclicality. And number 6, they're returning a lot of capital in the form of buybacks. 1 through 6, they check every single box. Exactly what we want to see. So far, I would call Ulta Beauty a compounder. I would call it a good company, as Terry Smith would define it. It has all the qualities of a good company, both qualitatively and financially speaking, the actual measurements and ratios of it. But does that mean that we just jump in and buy it? We found a good company and we can buy it at any price? No, that's not what it means. The next step is actually looking at the valuation. We don't only want to buy a compounder, but we want to buy it when it's trading below its intrinsic value. Now, valuation has lots of arguments, lots of debates. I'm not saying how to value a company. I'm saying this is the way that I value a company. These are two different methods that I look at and that I really prefer as simple ways to try to gauge whether or not you're overpaying or underpaying. I'm calling this my valuation framework, and I'll leave a link to this so you can have these little images here, these little slides. But in my valuation framework, I'm using the work by Morgan Stanley, someone that works there that put together this table that shows a chart relationship between the return on capital employed and the earnings growth of a company. So basically, the multiple the company should trade at, which these numbers in the matrix are the PE ratio, that should depend on both the earnings growth rate of the company and the returns on capital employed. And let's go ahead and go through this first way of valuing Ulta Beauty. We want to take the earnings growth and the returns on capital employed and see what the appropriate multiple it would be. Right now, the company is at an 18 forward PE ratio. I've seen estimates from around 18 to 20. So it's around that range, 18 to 20 forward PE ratio. Let's go ahead and look at the earnings growth of the company. If we look at the 10 years, oh, the earnings growth are wild. Look at this earnings growth, 31% CAGR, 31%. That's fast. That's faster than most companies I look at. That is an incredibly fast compounding company. 5 years is 32%, very fast. The 2 years is 41%. And then the 1 year, obviously that one doesn't make much sense because it's going based off of the COVID years. But even the 2 years at 43% annualized, they're doubling their earnings in 2 years. This is fast earnings growth. Now, having said that, this is history. We're looking at what's happened with the stock. And when we're looking at valuations, we're trying to predict the future. So we can't just plug in the recent past, what's happened over the past 10 years, and assume that's going to happen for the future. In fact, if you look at valuations over time, one thing that predictably happens with companies is their earnings growth predictably slows down. Over time, it will slow down. It really doesn't matter what company it is. They might be able to extend it for long periods of time. That's called massive outperformance. But in most cases, we want to assume, to be conservative, that their earnings growth is going to slow down substantially. In my opinion, I think it would be safe to assume that their earnings growth is not going to be 31%, not even close to that. I think over the next 10 years, they might be able to get 10% EPS growth. So we're going to assume a massive slowdown. And that leaves us some upside. If they do grow at 15%, that's just further upside because we bought it on the assumptions they're only growing their EPS at 10%. So we're assuming that conservative slowdown there, and we can assume they're going to grow at that 10%. The other thing that we look at again is the ROCE. Let's go ahead and switch this to annually here to see the full years. We have 2022 so far, but I'd like to use maybe 2018 and 2019 numbers. I think it will be more similar to this overall because we've had some wacky years here. So let's go ahead and look at 35% and 36%. Crazy high ROCE. Let's go ahead and look at the valuation framework here. Based on these two things, the returns on capital employed of 35%, 36%, and earnings growth assumptions of 10%, we're off the charts here. We're completely off the charts. At a minimum, the company, based on this assumption of an 8% cost of capital, at a minimum, we're looking at a 25.7 forward PE ratio. So basically a 26 forward PE ratio with lower ROCE and lower earnings growth. What does a company trade at right now? Ulta Beauty again trades at a 24 PE ratio. So basically looking at the returns on capital here, with an ROCE in the mid 30s and an earnings growth rate assumption at 10%, the company's undervalued with quite a bit of wiggle room. We can have the ROCE go a lot lower from the mid 30s to 24, and it's still worth a 25.7 forward PE ratio. The company trades at an 18 to 20. So I think the company, based on these assumptions, is conservatively, very conservatively undervalued. It should be trading right now, even conservatively, at around 25 forward PE ratio. So it's maybe 20, 30% undervalued based on these assumptions. But we have another way that we can look at the valuation here, another point of reference. We can use the free cash flow of the company. This is one that Terry Smith employs with his investments. He looks at the free cash flow of the company and the free cash flow growth. And what he tries to do is find companies where the free cash flow yield is greater than 4%, preferably above the 10-year treasury, and the growth rate, the free cash flow growth rate of the company, is at 10% or above. So you're looking for those two basic things. The company has a starting yield of 4%. You can think of it as a bond that has a 4% yield, and the growth rate is going to be 10% or above over the next decade. Let's go ahead and look at Ulta Beauty here again. Well, based on the last year, right now, the free cash flow yield of Ulta Beauty's 6.7%, well above that 4% mark. And it can drop down, and we're still quite a bit above it, right? So we meet that threshold right off the bat. But then we can also look at the free cash flow growth rate of the company. Over the past 10 years, the compound annual growth rate is 25%. Past 5 years, it's 27%. Past 2 years, it's 5%. Now, in my opinion, once again, we don't want to just use the past 10 years numbers and extrapolate that into the future, because it's likely that it slows down a bit. It's not going to be 25% CAGR for the next 10 years. But I think it is safe to assume that it's going to be around 10%. I think that their earnings growth will be predictably at around 8 to 12%, and their free cash flow growth will be around the same. Given the fact that they're starting with such a high free cash flow yield, because the company's so discounted right now, even with a 10% or 8% free cash flow growth, the company is once again attractively valued based on these metrics here. I think either way you look at the valuation, the company is trading at an attractive valuation. So there you have it. I consider Ulta Beauty to be both a compounder, a very good company, and I think it's selling at an attractive valuation. Now, that doesn't mean the company won't trade down anymore. A company being undervalued can still go down a lot with a general market sell-off. So there's nothing stopping this company from trading down. But I think right now it's both a quality company trading at a discount. What I do at this point, this is basically what I do, is if I find a company like this, I'll go to my watch lists here. I'll go to the Story Fund watch list, and then I'll just add it in. I'll add in Ulta here. I'll say right there. It kind of maps out how these companies are trading. I can see that Ulta right now is trading in line with its 200-day moving average, which is better than the market, so it's holding up well. And I'll look for different entry points in this company. What I'm doing is I'm evaluating these companies not only in isolation, but also against each other. So anytime I might look at buying Ulta Beauty, knowing that it's a good company at a reasonable valuation, I'm also looking at Microsoft and balancing it against that. So it doesn't automatically mean I'm going to go out and buy Ulta Beauty today. I have to buy it if I think it's currently the best value out of all the other options, all the other research I've done on all these different companies. Is it a better value company right now, a better buy than Microsoft? That's different questions you can ask yourself. So that's my thought process overall. I hope you enjoyed this video. I think Ulta Beauty is a very good company, and I may own it in the Story Fund in the future. And I'll let you know if that happens. But that's the video for today. I hope you enjoyed. Have a good weekend.